Welcome to the fourth quarter Wespath webinar. My name is Joe Halwax, Managing Director of Wespath's Institutional Investments team, and I'm coming to you from our offices in Glenview, Illinois. We continue to work in a hybrid format and remain flexible to the Delta, the Omicron, or any other Greek letter variant. In the past 2 years, we've adapted to working fairly harmoniously at the home, office, or anywhere with a connection for that matter. Just like all of you, who I'm sure have done a few meetings from a basement, an airport, or at home with a barking dog. Our clients continue to evolve their businesses, and we will continue to push through and be successful in this new normal. Today, I'm going to give a brief organizational update, cover our work in sustainable investments, update you on the markets, the performance of our funds, and close it out with an economic update from our Chief Investment Officer, Dave Zellner. Wespath has a few new faces to introduce. First is Neil Sobczak, who's part of the institutional investor team or the client team. Miles Smith, who joins our analytics team, and Ryan McQueenie is joining the Sustainable Investment Stewardships team. Welcome to all of you. And now we welcome our new General Secretary, Andy Hendren.
Thanks, Joe. It's good to be here.
So Andy, are there any changes to the Wespath institutional fund offering that you're excited about?
There are a few. I'm really pleased with our most recent addition of a strong sub-accounting platform and partner in Stellar. This brings capabilities and efficiencies for our institutional investors who have needs to separately track more than one account, fund, or endowment. Another big win for Wespath's clients and prospects is that Wespath has recently become GIPS compliant. That's the Global Investment Performance Standards. In addition, our GIPS compliance has been verified by an independent third-party auditor. What this means is our investors can count on the accuracy of our investment performance, reporting, and more easily compare us with our competitors. This holds Wespath accountable and honors the transparency that our investors deserve. And lastly, I'm excited by our plans to add a new alternative investments fund for our clients. This fund will offer investors the opportunity for greater diversification within Wespath's offerings and a new avenue to pursue private market returns.
Yeah, that's great. Those are all exciting things. And then thinking about growth, what are the growth opportunities that you see?
Number one, the best growth opportunity is to continue to grow in partnership with our current clients. Whether it's helping our foundation partners secure new business, or it's growing the asset pools for our mission organization clients, all of Wespath's customers benefit, and the broader connection strengthens when our investors succeed and grow. Second, I also believe we have new opportunities for growth and partnership among United Methodist affiliated organizations, like children's homes and older adult facilities. To that end, we're strengthening our partnership with the United Methodist Association of Health and Welfare Organizations, or UMA, and its member institutions, because there we see really strong alignment of missions and great opportunities for collaboration. Third, I'm excited about the prospect of providing services to organizations from closely related faith traditions to the United Methodist Church, such as Pan-Methodist churches and perhaps other faiths in covenant relationships with the UMC. These opportunities may bring Wespath additional scale, which again benefits all of our customers, but it also serves to honor the values of Christian unity and shared purpose.
Yeah, thanks for that. A topic we hear frequently is about General Conference. So can you tell us, how are we preparing for General Conference? And then also, what happens if General Conference is again delayed?
That's the $50,000 question, Joe. Like most in the connection, we await word from the Commission on General Conference about whether the conference will be further delayed due to the pandemic. But we haven't been sitting on our hands, waiting. Working with our board of directors and in close dialogues with stakeholders, we've continued to study our proposals to the General Conference regarding the denomination's benefit plans and Wespath's governance. We've identified some improvements and some necessary adjustments based on the last 2 years of pandemic experience, and we'll be prepared to suggest amendments to our proposals when the General Conference does finally meet. If General Conference is delayed further, what we'll do is we'll really seek to offer the best support we can to our customers and work with stakeholders to navigate the current circumstances and plan for the future. We continue to be a resource to our investors as they reflect on their mission and their structures and their own business models as the church navigates all of this uncertainty. We'll also use the denominational pause as an opportunity to focus on improvements to our service model and spend more time building stronger relationships across the church.
And in terms of challenges or opportunity, what do you see in terms of your first year in this role?
Without a doubt, technology is a big challenge. It's on my mind a lot. As we see it in our daily lives, technology is changing all around us at a rapidly increasing pace. Like society in general, the church is adjusting to this new digital age. Just what the metaverse and Web 3.0 and cryptocurrencies and non-fungible tokens mean to retirement plans, institutional investors, asset owners, and the very nature and mission of church, that all remains to be seen. But I know that Wespath needs to be ready for an ever more digital future in our service model and in our investment strategies. To that end, as a beginning or as a next step in that journey, Wespath has hired a Chief Information and Technology Officer, and I'm excited about this. This position will help ensure that we're focusing on the digital future and the landscape as a priority. Another priority is staying closely relational with leaders and stakeholders across the denomination. The church is changing, without a doubt. Disaffiliations, the pandemic, reforms to the structure of the church, and a potential pending separation bring uncertainty. But they also bring opportunity, and that's what excites me about it. Staying in close dialogue with influencers from across the spectrum of views and from diverse segments of the church will help Wespath meet the church and meet our customers where they will be and provide them the support and services that meet their needs of tomorrow and not just today. I'm a firm believer in the strength of the connection in the UMC's DNA, and I believe it will endure if our connections become different or looser or more flexible down the road.
Right, and then another question we're thinking about is, are you planning on implementing any changes in your new role?
Joe, I'm not really a believer in change for the sake of it. Wespath is in a solid position thanks to the legacy of Barbara Boisigrain's 27 years of ministry leadership in service to the church. But change is inevitable, and sometimes it can be unsettling. My philosophy is being open to and having faith in thoughtful, intentional, data-driven changes that further Wespath's mission and the long-term security of our customers.
Great, thanks for that, Andy. We appreciate you being with us today.
It's been really good to be here.
Welcome to the market update for the fourth quarter. The last 6 months of the year, COVID provided us whiplash, seemingly near the end of the pandemic in July, only to have Delta in the fall and Omicron in December. It would be great to have an update that didn't include COVID, but we're not quite there yet. The fourth quarter was positive for the equity markets and relatively flat for fixed income. The themes that are driving markets remain the same: COVID levels, and related to COVID, the normalization of monetary policy, known as tightening, real estate and regulatory concerns in China, and the theme we will discuss most with clients and prospects is inflation. Let's start with a COVID chart from JP Morgan. I'm sure you're all well aware of Omicron, which showed up just in time for the holidays. Personally, I knew more people that caught the virus in 2 weeks than in 2 years, and I'm sure many of you had the same experience. Omicron's a double-edged sword. So looking at the blue line that shows a huge spike in cases, but the black line is deaths, which is flattening. So while Omicron is the highly transmissible variant, there's hope that as the country catches this seemingly mild variant, we may finally be able to build natural immunity to future variants, which could bring the long-awaited herd immunity. On that thought, the first week of market activity reflects the belief that herd immunity is likely. Rates have risen sharply to start the year, reflecting inflation and continued economic expansion. And in equities, we've seen a rotation from large growth stocks to cyclical stocks, those that perform better in an economic recovery. Looking at equity returns for the quarter and the year. The S&P 500 returned 11% on the quarter and over 28% for the year. Over the last 3 years, we've seen just over 26% in annualized returns. The Russell 2000, or small cap index, returned just over 2% for the quarter and just under 15% for the year, roughly half of that of the S&P 500. International markets continue to lag those of the US. The MSCI EAFE index returned 2.7% on the quarter and 11.2% for the year. The 3-year annualized average is 13.5%, again, roughly half of those seen in the US. The MSCI Emerging Markets Index lost 1% on the quarter, and 30 basis points for the year, a sharp divergence from the rest of the world. Remember that China is roughly 34% of the emerging markets index, and China faces concerns over the real estate market with possible defaults, and also investor concern over continued government regulation for their technology names. For the year, the Chinese index was down over 21%, driven by technology and real estate. This was the main driver of negative emerging market returns. In previous updates, we mentioned that the market impact of the large names in the U.S. equity market. Many of these are the household tech fangman names. These names are experiencing some of the widest divergence in terms of valuation from the rest of the market. So while large cap techs have been big drivers of U.S. equity performance, they also now are very expensive relative to the rest of the market. In this webinar, we included the returns for the top 7 names of the S&P 500, with a return of 13% on the quarter and 36% for the year. Lastly, I'll note that the best returns for the quarter and the year from the Wilshire Real Estate Index at 17% and 46%. REITs have over twice the yield of U.S. stocks at 2.9%, and were also driven in 2021 by a stronger economic recovery, including increasing rents and occupancy rates seen during the year. Looking at the Morningstar style boxes for the quarter, the key thing to note here is the left columns of both boxes. This represents the value style, and as you can see, value has largely outpaced growth for 2021. We would expect value to outperform growth last year, a year with strong economic expansion, sharply higher inflation expectations, and rising rate expectations. Note that since the year 2010, growth has largely outperformed value, but headed into 2022, value looks attractive from a valuation perspective because value stocks are significantly cheaper, and as rates are expected to rise, this has been historically a tailwind for value names. Before we look at fixed income, let's take a quick look at the U.S. yield curve. Looking at the red curve, that was a year ago when we started 2021. And remember, we were somewhat optimistic for the vaccines to end COVID, the economy was starting to improve, and we also were aided by a massive federal spending bill that passed in January of last year. The blue line is 3 months ago, a large shift higher in interest rates across the board, largely reflecting rising inflation. And the green line is the end of December, showing much higher rates in the front end with some curve flattening. So why is that? Well, because now the market is expecting rate hikes, which impacts the short end of the curve. Looking at expectations for interest rates, I mentioned that we are expecting interest rates to rise. And this chart shows that we're now looking at 3 interest rate hikes of 25 basis points in 2022. Now let's remember how this has changed. 1 year ago, the market was pricing in the first rate hike in April of 2024. Last August, 6 months ago, the market was pricing in the first rate hike in August of 2023. So in a year, the expectations for rate hikes have been pulled forward by more than 2 years. This in response to economic growth and inflation that has spiked for the last 6 months. In addition, last week the Federal Reserve minutes indicated more hawkishness than expected. Beyond expectations for higher interest rates, there are also discussions about shrinking the Fed balance sheet. So in 2022, we're likely to have a scenario of the Fed tightening, stopping balance sheet expansion, and then moving to fully balance sheet contraction. This is a significant amount of monetary policy tightening in a short amount of time, and very different than the backdrop of the last 22 months. With higher rates across the board, there are negative returns for the broad bond index, the Bloomberg Global Aggregate, and also the U.S. Treasury Index. For 2021, the returns were -4% and -2% respectively. However, the high yield index posted a positive 70 basis points on the quarter and just over 5% for the year, as investors sought high-risk bonds and as spreads versus Treasury compressed. Investors sought higher-risk bonds as the economic outlook improved and the chances for default decreased. The U.S. inflation-linked index was up 2.5% on the quarter and 6% on the year, as inflation concerns grew in the U.S. and U.S. rates moved higher. This is something I will discuss with Dave later in the webinar. Lastly, the Bloomberg Commodity Index lost over 1.5% for the quarter, but was up over 27% for the year. So remember that the commodity index's largest component is energy at roughly 30%, and energy prices are sharply higher on the year. This is again part of the inflation theme that's one of the main drivers of 2022. That wraps up the market update for the fourth quarter. Let's take a look at how the performance of the markets impacted the Wespath fund returns. With that, I will turn it over to my colleague Karen Mansko for the update.
Thanks and hello everyone. The chart on the screen shows the net of all fee performance of the individual Wespath fund composites versus their respective market indices. The first row in the chart is our multiple asset fund, which is our flagship balanced portfolio. As a reminder, this fund has a 65% allocation to equities, 35% allocation to fixed income. The funds directly below the multiple asset fund are the 4 core Wespath funds that comprise it. The first column on the chart showcases the fourth quarter net of all fee performance results. And as you can see, and as Joe mentioned, the stock market performed positively after coming out of a negative third quarter, which created positive absolute performance for the multiple asset fund and the 2 equity funds that comprise it. Focusing on the 2 equity funds, which are the first 2 funds listed below the multiple asset fund in the chart, as I mentioned, these 2 funds comprise 65% of the multiple asset fund and were the primary driver of the quarter and year results. And those results were stock selection by our active managers. I'm going to highlight in a moment specific companies that impacted the performance. Also, the U.S. equity fund has an underweight allocation to mega cap stocks, which are the largest U.S. companies. This detracted from performance as we saw some really strong gains from these stocks this year. On a positive note, the 2 equity funds allocation to private equity contributed to the fund performance as we've seen strong results posted from this asset class for the quarter and year. Moving on to the 2 bond funds, starting with our fixed income fund composite, looking at the chart, you can see the fund modestly underperformed for the quarter and slightly outperformed for the year, net of all fees. The Inflation Protection Fund posted solid results for the quarter and the year, performing about 1% for the quarter and 6% for the year. And I'm going to talk more about this in a moment. Despite the quarter and year underperformance we experienced from the multiple asset fund and its corresponding funds, specifically the equity funds, you'll notice that if we separate out the 2-year fund performance time frame, which essentially is the COVID market time frame, which we normally don't highlight in our webinars, it showcases the extraordinary event of COVID and the impact it's had on the markets and our strategies. So looking at this time frame closer, you'll see that the multiple asset fund and the international equity fund outperformed their benchmarks, and the U.S. equity fund performed in line. The final comment I'll make on the slide before we move on is that despite the 2021 underperformance of the multiple asset fund, you can see that the fund has outperformed its benchmark across all trailing time periods, net of all fees.
That 2-year perspective is really helpful, Karen, because of the volatility quarter on quarter. It's been fairly high, and there's been a significant change in the stocks that outperformed from 2020 to 2021. So putting in that context, the 2-year COVID time frame is really helpful. So back to multiple asset fund, how did it perform against peers?
That is a great seg into the next slide. And this chart showcases the multiple asset fund composite versus a universe of balanced funds. The universe is different from what we've shown in previous webinars. We want to measure how our balanced fund, the multiple asset fund, performed relative to other balanced portfolios and funds that are currently on the market. So we're using a universe that is compiled and maintained by Investment Metrics, which is a very well-known reporting provider in the investment industry. One of the things I'll point out is that the information is updated as of year end and presented net of all fees. So you can see by looking at the chart that the multiple asset fund has performed below the median for the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time frames. For instance, in the 10-year time horizon, the multiple asset fund outperformed over 63% of other balanced funds in this comparison.
So Karen, moving on, tell us about the individual fund contributors and detractors for 2021.
Starting with our multiple asset fund, I talked briefly about this on the performance slide, but you can see the primary driver of the fund's underperformance for the year was the modest underperformance of the 4 funds that comprise the multiple asset fund. And I'm going to talk specifically about each of these funds in a moment.
Great. I mentioned during my comments that the equity markets were positive in the fourth quarter and for 2021, with the S&P 500 hitting new highs. How did the underweight of large cap in our U.S. equity fund, how was that impacted by this move in mega cap stocks?
You're right, Joe. The S&P 500 hit all new highs and ended the year in really strong results. What I find interesting is that 30% of that index return was driven by just a handful of mega cap names, which you highlighted in your equity market update. While we often say that we're underweight large cap stock, it really isn't underweight to mega cap stocks. And this, unfortunately, was a big detractor to our relative performance of the fund. With this said, the long-term strategic allocation to overweight small and mid-cap stocks and underweight mega-cap stocks detracted, as we saw small and mid-cap stocks just really couldn't keep pace. Another detractor to the fund was our active manager stock selection. 3 of our 6 active managers underperformed, and specifically our 2 longest standing investment managers, Brown Capital Management and Zevin Bergen. These 2 managers have historically been the best performing investment managers in our U.S. equity fund. And their investments in companies like Teladoc, Exact Science, and Proto Labs detracted from performance. These companies had really strong gains in 2020, but with that market rotation that we saw in 2021, these companies fell out of favor as investors moved into names that they believe are more pro-cyclical and they felt that would benefit from an economic recovery and higher interest rates. But on a positive note, the fund's allocation to private equity contributed to performance as private equity investments this year have posted some solid results. Turning our attention to our international equity fund, similar to the U.S. equity fund, is that the fund's primary underperformance was driven by stock selection of our active managers, specifically companies in China, Japan, and the UK. Joe, you noted earlier that our investments in China have been impacted by that continued government regulation and the impact that this had on technology companies. Also, the UK company Ocado, which is an online grocer, was impacted by inflation and the labor shortages that we've experienced. The final note I'll make on the slide is that the fund is underweight developed markets in lieu of having an allocation to international private equity and private real estate. This underweight was a detractor since we saw developed markets return over 11% last year, but this was offset by our performance results in our international private equity allocation.
So Karen, it seems like the main driver to the equity funds was the underperformance due to stock selection. So have we seen any major changes to the holdings from our active managers?
We've had some extraordinary years in the equity markets, and that's both benefited our active equity investment strategies and also has not benefited them. I think it's worth reiterating that our investment managers invest in companies that they believe will generate outsized results over multi-year periods. They don't invest just to capture short-term market gains. As a long-term investor, we understand and know that our investment managers or any investment manager will not always outperform. We've seen our investment managers make modest changes in their holdings while still continuing to adhere to their mandate that we've hired them to manage. We believe we have skilled investment managers that will continue to find investment opportunities that have not been fully appreciated by the market, and they will outperform over the long term.
Thanks, Karen. So moving on to the fixed income fund's performance, I noted during my market update that bonds have improved since their rocky start at the beginning of the year. Specifically, high yield bonds have done well, while treasuries and global bonds ended up in negative territory. How did this impact the fixed income fund, given the allocation to high yield and global bonds?
It's really been a challenging year for bonds, with the exception of high yield and U.S. inflation-linked bonds, which I'll talk more about that when I talk about our inflation protection fund. As you showcased earlier, high yield bonds were up over 5.3% in 2021, with the other bond asset classes in negative territory. When you showed the change in the yield curves, you saw that the yields increased from the end of 2020 to the end of 2021, which had a negative impact on the bond market year to date, all with the exception of high yield bonds. It's also worth noting that the US dollar increased relative to most emerging market currencies last year, which had a negative impact on some of those allocations in our funds. So with this said, the fixed income fund slightly outperformed its benchmark on a gross of fees basis. If you're focusing on the left part of the slide, you'll see the contributors, and the fund's overweight allocation to high yield bonds positively contributed to the fund performance, along with the issue selection by our Core Plus manager, PIMCO. I also want to note that our internally managed positive social purpose lending program also was a contributor as we saw credit spreads tightened, which benefited this investment. And also the fund's allocation to alternatives contributed to performance. Detractor to the fund performance includes the overweight allocation to global and emerging market bonds, specifically emerging markets, as we saw the dollar increase relative to those currencies last year.
All right, Karen, so moving on to our final fund, the Inflation Protection Fund. This fund has posted some solid gains this year and that you highlighted during your fund update. So tell us more about that.
Yeah, the Inflation Protection Fund really has showcased its purpose this year as being a fund that was created to protect investment portfolios against unanticipated inflation while providing a stream of income. And the fund returned over 6% in 2021. Relative to the fund's custom benchmark, the fund's underweight to UK inflation-linked bonds contributed to the performance. And despite US Treasury inflation-protected securities and floating rate senior secured loans having strong performance last year, the fund's overweight allocation to this asset class detracted from the fund performance since they couldn't keep pace with the fund's custom benchmark, which has a 10% allocation to commodities. And speaking of commodities, you noted earlier that they had a really strong year last year, primarily due to the increase in energy prices. And our overweight allocation to this asset class contributed to the fund performance. Finally, similar to our fixed income fund, the fund's allocation to emerging market inflation-linked bonds detracted as we saw the US dollar increase relative to these currencies, which also impacted this asset class. As I conclude my portion of the webinar, you noted that the markets rotated, and we saw that starting in the beginning of 2021. The areas of the market that did well in 2020 and before look much different than they did last year. And if I think about what was a contributor to the market movements and rotation, I think about how we came out of 2020 with the prospect of a vaccine that was really going to bring our lives some normalcy, back to those pre-COVID days that we all know. We learned about other COVID variants such as the Delta and Omicron, and how they can just as easy take the wind out of our sails and push back the idea that our lives will get back to those pre-COVID times. This also caused the markets to shift, which did not work in favor of our diversifying strategies. Given the remaining uncertainty in the market, we believe it's important to maintain a well-diversified portfolio and not to make drastic portfolio shifts as we move forward into 2022 and years following. We understand that there will be periods where our funds will be out of favor, but we believe that those periods will be few and far between. And as we've showcased through the year, our long-term strategic approach to investing has served our investors well in the long term, and will continue to maintain this strategic approach in the management of our funds.
Some great perspective, Karen. Thanks for that update. I'm now joined by Ryan McQueenie, our newest member of the Sustainable Investment Stewardship team. Thanks for chatting with me today, Ryan.
Yeah, thanks for having me, Joe. It's always great to talk to you, and it's really exciting to make my webinar debut. I've been a part of the Wespath team for a few years now, and I've always had a passion for our sustainable investing work, so I'm very pumped to get going.
So with that, let's indeed get going. I want to talk today about and have an update on climate change, which is one of our sustainability themes here at Wespath. What's the latest on climate?
Yeah, Joe, it was definitely another busy quarter and really a landmark year for the global response to climate change and climate as a stewardship topic in general. In Q4, we continued to make great headway with our collaborative engagement partners, notably Climate Action 100+. Through this group, we contributed to a groundbreaking paper focused on the electric utilities industry and what the path to net zero needs to look like for electric utilities around the world. This industry literally powers the energy transition for so many others. That's pun intended for the record. So it's a key group in the net zero conversation. And this paper sets out a clear roadmap for how the industry can achieve net zero and how investors and policymakers should be supporting that transition. We've also for years led the Climate Action 100 engagement with Chevron, obviously a huge player in the traditional oil and gas business. And we're really pleased to report that in Q4, Chevron announced a new net zero aspiration and updated its greenhouse gas reduction targets. This new goal includes a Scope 3 target covering emissions from the use of its products.
It's really exciting news, Ryan. And the other thing, really, of course, was that there was the big headline-grabbing event in November, COP26 or COP26. I'm certainly that most of our viewers have heard about it, but what can you tell me in terms of takeaways from that event?
For sure. COP26 definitely felt like the culmination of the entire year for those of us working on climate issues. In some ways, I'd say we're still trying to catch our breath and digest the news, but I do think there were some great announcements. A global pledge to reduce methane emissions, a partnership to end deforestation by 2030, and even on the private side, some consolidation of leaders in the sustainability disclosure world. What's most important is how all that turns into action as we move forward. So that's what I'm going to be keeping my eyes on in the near future.
That sounds good, Ryan. So sticking with climate for one more minute, though, we do have some awesome news with Wespath and our partners at Net Zero Asset Alliance.
That's right, Joe. Both myself and my colleague Jake Barnett are going to be stepping into co-lead positions in Alliance working groups for the upcoming year. I'll be working with the communications group, and Jake will be co-leading the engagement group, where he'll be trying to leverage our influence as global asset owners to deliver important and tangible change throughout the economy.
Well, congratulations to you both. I'm looking forward to what you guys can achieve in your new positions.
Thank you.
Well, let's switch gears real quick and talk about COVID. So with Omicron spreading quickly and cases reaching all-time highs in early January, what are we thinking about COVID from a stewardship perspective?
For us, it continues to be about an equitable global response to the pandemic. This was something we've been supporting for a long time. Really, as early as vaccines became widely available, we endorsed the Access to Medicine Foundation's investor statement calling for the fair distribution of vaccines and other COVID resources. What we've seen, and as this chart shows, is a huge gulf in vaccine distribution rates, with the lines drawn along socioeconomic divides. In other words, the rollout of vaccines to low-income countries has lagged significantly. We do think this has economic implications. For starters, we certainly know that the pandemic has been linked to the rise in inflation, and it also stunts the global recovery, as countries with low vaccination rates are more likely to prolong the COVID-related economic restrictions that they have in place. So what are we doing about it? I mentioned the investor statement. Part of that statement was support for the ACT Accelerator. This is a multi-stakeholder partnership dedicated to developing and ensuring equitable access to COVID tools, of which vaccines are one of them. We've also engaged with pharmaceutical companies involved in the production of COVID vaccines, trying to make sure that they're meeting their commitments to meet vaccine demand around the world. You can find more about all this work in a post on our Investment Insights blog. It's written by my colleague Shirag Acharya. I encourage you to check it out if you haven't already. It kind of covers the issue of vaccine equity and then talks about what we're doing in response. Going forward, we're going to continue to work with our peers and our external asset managers to find ways that our stewardship work can support vaccine equity.
Thanks for that, Ryan. Are there any final thoughts as we wrap up?
Yeah, I just want to quickly mention a few new focus areas that we're going to be exploring throughout 2022. This is going to be a year with some exciting collaborations with like-minded investors and investor initiatives. Viewers have already heard about our work with the IOPA, it's the Investors for Opioid and Pharmaceutical Accountability. We'll be prioritizing that again this year as the scope of those engagements continue to expand. And we're really excited to dive into the theme of digital surveillance, which is somewhat of an emerging topic as conversations about digital privacy continue to evolve. And finally, we'll be taking a closer look at the just transition, which is a way to describe the important social implications of the transition to a low-carbon future.
Thanks, Ryan. Look forward to hearing more about these exciting initiatives later this year.
Thanks.
So, Dave, I'd like to start off with the stock market. The S&P 500 rose 28.7% in 2021 on the back of 2020's 18.4% gain and 2019's 31.5% gain. That's a compound annual rate of return of just over 26% for the last 3 years. In fact, the stock market has returned 16.5% over the last 10 years, with only one down year back in 2018. How long can this possibly last? And do you really think the market can go up again in 2022?
Yes, well, as you know, Joe, Wespath doesn't try and predict the direction of the US and world stock markets. We have a disciplined, long-term strategy, and we'll continue to adhere to this strategy. But you're right. We've seen exceptional gains in the US stock market over the past 3 years, 10 years, and yes, again, last year. The S&P 500 declined just 1 year in the past 10 years, and that was only a decline of about 4.5% in 2018. What's more, the average annual return of 16.5% that you cite substantially exceeds the low single-digit returns that many prognosticators were predicting just 10 years ago. Now, the first chart that I'm showing looks at US stock market returns over the last 25 years. The blue bars represent the total return for the S&P 500 for the specified year, and the red triangles represent the largest drawdown or peak to trough decline for the specified year. The last time we had a prolonged bear market was when the tech bubble burst back in 2000. And except for the abbreviated bear market that occurred with the great financial crisis of 2008 and early 2009, the market has provided really generous returns since 2003. Now, there's one other feature of this chart that I would like to highlight, and that's the peak to trough decline in 2021. From early September to early October, we saw the markets decline a little over 5% as inflation appeared to be more transitory than the Federal Reserve hinted that it would be, and that it indicated that it was going to be more aggressive at that time in fighting inflation. But that decline was just the second smallest peak to trough decline in the last 25 years, second only to the least volatile year ever, which was just 5 years ago in 2017. Now, I do feel compelled, Joe, to try and put some of these market gains into perspective. You spoke earlier about the valuations of the large infotech companies. When I prepared my remarks for today, there were 7 infotech companies that comprised 26% of the S&P 500. Apple, Microsoft, Google parent Alphabet, Amazon, Meta, which is the new name for Facebook, Tesla, and NVIDIA. Now, for our viewers that may not be familiar with NVIDIA, it's a technology company that manufactures hardware and semiconductor units used in gaming, automobiles, and components for supercomputers. This chart looks at the average 5-year returns for each of these infotech giants. One certainly must question the extent to which these infotech giants can continue to grow at these rates. The market value of Apple recently exceeded $3 trillion. The New York Times reported last week that Apple alone is more than the combined market value of Walmart, Disney, Netflix, Nike, ExxonMobil, Coca-Cola, McDonald's, AT&T, Goldman Sachs, Boeing, IBM, and Ford, again, combined. Now, I love Apple products, and I'm embarrassed to say how many Apple products I own, but $3 trillion, that's a valuation that is really difficult for me to comprehend. So back to your question, Joe, about whether one could reasonably expect increased market gains in 2022. It's difficult for me to expect continued leadership from the 7 companies that make up more than a quarter of the index. That said, corporations buying back their own shares could continue to provide the overall market with continued gains. The next chart looks at share buyback activity over the last 17 years. Buybacks for the third quarter of 2021 set a record, with S&P 500 companies purchasing 235 billion of their own shares. And all indications are that buybacks in the fourth quarter will match or exceed the third quarter's record. Companies will typically scale back repurchases during periods of economic uncertainty. We saw that back during the great financial crisis and again at the onset of the pandemic. So if we continue to see a reasonably strong economy in 2022, then one should expect to see continued share buyback activity, which could lead to more positive results for the stock market. All that said, it's extremely difficult for me to perceive that we will see returns anywhere near what we've seen for the last 3 years.
That's some great perspective, Dave. And I'll note that you said that buybacks would likely continue if the economy continues to grow. So let's talk about economic growth. What are your prospects for continued US and world growth in 2022? And also, what do you think might interfere with continued growth?
Sure. I'll start with the US, Joe. We won't see the first reading on fourth quarter GDP until January 27th. On the left of the chart, we show the Atlanta Federal Reserve's GDP Now forecast for the fourth quarter. They are predicting the economy grew at an annualized rate of 6.8%, which means that the overall economy would have grown by 5.5% for the entirety of 2021 when adjusted for inflation. That was pretty close to the forecast made by the International Monetary Fund in its World Economic Outlook at the beginning of the year, and that was 5.1%. On the right side of the slide, we show current projections for 2022 for the US and other parts of the world. The numbers here represent the median prediction from over 40 reputable sources. Presently, economists are predicting that the US economy will grow at an inflation-adjusted rate of about 4% this year. And while that's lower than other parts of the world, it's really not unexpected given that our economy bounced back better than most other economies did. Now you ask, what might interfere with continued growth? And I think we all know the answer, and that's inflation. That said, I do think some wonder if another more deadly variant of COVID could wreak havoc with the economy. In fact, last week, we saw over 5 million workers call in sick because of the less deadly Omicron variant. And because of this, economists have already begun to lower their first quarter growth forecasts. But it does look like inflation is going to stick around for a while, which could lead to more aggressive action from our Federal Reserve to fight it with the risk of slowing the economy.
So let's dive deeper into the inflation risk, Dave. The consumer price index increased 7% in 21, which is far higher than anyone predicted. Now, why is it so high, and why does it continue to persist? And do you think the inflation that we're presently seeing will revert back to more acceptable levels?
So let's start, Joe, by taking a look at how inflation played out during 2021. This first chart on the slide represents the Fed's preferred inflation measure, which is the Personal Consumption Price Index. Although we haven't yet seen the December report for the PCE, it's fair to say that it will meaningfully exceed the Fed's 2% target for the 9th straight month. The chart on the right is what most of us view as the nation's inflation gauge, the Consumer Price Index. And as you said, Joe, this measure of inflation hit 7% year over year. There's no question that the Fed and others significantly underestimated the level of US inflation for 2021. Mohammed El-Arian is a prominent market commentator, and he's a special advisor to the German insurance giant Allianz. And he noted that this is the biggest miss of a forecast, of an inflation forecast on record. The table at the bottom of this chart represents the market's expectations for inflation for 5, 10, 20, and 30 years out. And as you can see, markets are expecting that inflation will average nearly 3% for the next 5 years. Now, this next chart looks at inflation rates for the three components that comprise nearly 3/4 of the Consumer Price Index. Earlier this year, transportation and energy accounted for most of the CPI increase. But lately, we've seen a steady rise in prices for food, shelter, and medical services. So why are we seeing stubbornly high inflation? Let's face it. In our last webinar, I said that we're buying a lot more stuff rather than spending our money traveling, going to restaurants, concerts, or ball games. I said a lot of us have moved and we want to make changes to the new home we purchased. We're also working more at home and we want better equipment in our home offices. We're getting to those projects that we've put off for years. Our spending patterns have changed in a big way. This dynamic continues especially since COVID gives no sign of going away. Economics 101 tells us that when the demand for goods and services go up and there's a shortage of supplies, as there are today, then prices are going to go up. Now, with the benefit of hindsight, it seems fairly obvious that inflation is a consequence resulting from all of this. But how long is it going to last? That's the question on everyone's mind. I've read numerous accounts that rent increases are certain to accelerate in the near term. Companies are feeling the pain of a severe labor shortage. Hence, we should expect upward pressure on wages for the near future. So I think, Joe, that we need to accept that inflation for at least 2022 could be meaningfully higher than what the Fed is hoping for. They continue to signal that they will act as required to rein in high inflation, but they are walking a tightrope. If they're too aggressive, they risk adversely affecting what many consider as an already fragile economy. If they aren't aggressive enough, they risk the unsustainable consequences of a prolonged inflation. So, Joe, no one really knows how long this current bout of inflation is going to last. We'll know more as the events of 2022 continue to unfold.
Great. Well, thanks for that color, Dave. For the listeners, we know that this is an important topic for you, and we'll continue to update you throughout the year and the rest of the quarter. So finally, Dave, let's talk a little bit about China. So as we both stated, the S&P 500 was up nearly 29% last year, yet some gauges of the Chinese stock market showed more than 20% declines. Why do you think there was such a big difference in returns, and do you think China still represents a viable investment opportunity?
Yeah, no question, Joe. China has been a disappointment recently. There are two reasons behind the poor returns we saw in 2021. First and the most obvious is China's zero COVID policy. It's remarkable to me that every day over the last few weeks, the US has reported 3 times as many cases in one day than China has reported over the entire pandemic. If Chinese officials detect but one case in a city of over 10 million people, they strictly lock down the entire city. And that means no one leaves their homes without permission except for the barest essentials. A second reason relates to China's crackdown on the tech sector. We discussed some of this during our last webinar. And I should say, Joe, that your question is one that we frequently discuss with our asset managers. But they remain convinced, as do we, that China's transformation to a prosperous society represents an excellent opportunity for investors. We will likely continue to see 2 steps forward and 1 step back, but we remain committed to maintaining exposure to the Chinese economy for a portion of the assets we steward on behalf of our participants and institutional investors.
Great. Thanks for that, Dave. It's a wonderful discussion in a complex and changing investment landscape. This concludes the fourth quarter Wespath webinar. If you have any questions, please send them to investmentinfo@wespath.org. Thank you to our clients for allowing us to be stewards of your assets. We appreciate your partnership.